Our property markets have slowed down. Have they peaked, or are they just taking a mid-cycle breather? That's what we're going to discuss today as we do a state-by-state property market update.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Boy, how things have changed in our property markets over the year. We had a heady start to the year, but the latest figures showed that property markets are levelling out. Values aren't going up. And although Melbourne and Sydney median house prices are hovering around their peaks, growth seems to have stalled over the winter months. So what's ahead for our property markets? What's actually happening on the ground? That's exactly what we're going to be discussing in this special, longer edition of our weekly podcast, where I'm going to have 4 experts sharing with me their on-the-ground thoughts as we do our state-by-state property market update. You see, the frenzy housing buying is fading, and our nation's hottest markets, particularly Melbourne and Sydney, seem to have come to a bit of a halt. APRA, I guess, is getting its way as it's pressuring lenders to encourage lower risk principal and interest loans, plus buyers needing bigger deposits. And they're also encouraging owner-occupiers back into the market. Those markets in particular have been dominated by investors like the strong Melbourne and Sydney markets. And we're seeing more first home buyers. In the past they were squeezed out by investors, but now they're making a bit of a comeback as the state's stamp duty concessions and first home buyers concessions are coming into play. We're going to go through each state in a moment and have a bit of a chat about what's happening in the local markets. So I hope you're going to get a better insight into what's ahead. I guess you're also going to realise that auction clearance rates have fallen from their highs of the last couple of years to the lowest point so far this year. And our markets remain fragmented. House prices were down in Darwin, 18% from their peak, 10% from their peak in Perth. And I guess what this has done is confirm that property prices don't always go up, a good lesson for property investors. So I guess the question a lot of Australians are wondering is the Australian housing market just consolidating in preparation for another part of its rise? You know, a mid-cycle catch-up catching its breath like it's done a few times this cycle? Or have we finally reached the peak? Now, the spring selling season is just around the corner, and that's going to bring lots more properties onto the market. So we're soon going to find out if there's enough demand to absorb all this additional supply. But we can be sure of one thing. We're at a time of increased risk and increased volatility. So investors can't just count on automatic capital gains as we move ahead. You're going to need to have good judgment in deciding whether to buy, whether to hold, or whether to sell. So today I'm joined by 4 property experts as we take a whip around the country and also just look at our economy in general. First of all, we'll have Ken Race, Director of Metropole Wealth Advisory, to give us an economic context. Kate Forbes, National Director of Metropole Property Strategists, is going to give us an idea of what's happening in the Melbourne market because she's Melbourne-based. Ahmed Imam, Senior Property Strategist at Metropole in Sydney, is going to be giving a take on the Sydney market. And boy, are things changing in the Sydney market, so he's going to give us some ideas of what's going on. Brett Warren, our Senior Property Strategist at Metropole in Brisbane, will tell us what's happening in the Sunshine State. And I'll be going through each other capital city and a little bit about the regional markets as well. So there's lots ahead today in this longer session of the Michael Yardney podcast. Well, my first guest today is Ken Race, Director of Metropole Wealth Advisory, to give us an overview of the economy and the context in which we're going to be working as property investors. Welcome, Ken.
Thank you, Michael.
Now, Ken, Australia's what we tend to think about when we're talking about property and investing, but we don't work in isolation. So let's first start off with how's the world economy going, and then we'll dig deeper and have a bit of a talk about what's in store for Australia. So what's going on in the world economic terms, Ken?
Yeah, look, it's important to understand what's happening around the world because it influences what happens here. So in some instances it leads what we do, in other instances it lags. But I think overall the global economy is improving and above trends. And what's surprising is the labour market is pretty strong in relation to employment numbers. But like Australia, low wage growth is happening in most places around the world. So that's restraining spending, which then has the big flow-on effect into all manufacturing and consumption. But when we look specifically at the different regions, China is one of our, if not biggest, trading partners, and China is growing at a reasonable pace, predominantly driven by spending on infrastructure and property. So notwithstanding what we hear about a property bubble, a residential property bubble in China, there's lots of building as people migrate from rural areas into the cities and as people move up the wealth scale into middle class. So a lot of construction to move people, roads, rails, airports, energy, so power stations, and property to keep everybody living in. Now, China has a bit of a moratorium on taking money out to spend overseas because they want it internally. When we look at the US, that's probably one of the stronger growing economies, and the Federal Reserve
despite all the things that are going on with Donald Trump, Ken?
Yeah, despite everything, the share market is at high levels, unemployment levels are relatively low, there's activity, there's manufacturing, so it's well and truly better than just green roots or green shoots coming out of the ground.
So all the worry that we had a couple of years ago about a world recession really isn't transpiring, is it?
Correct. It certainly hasn't. I think the world has, if you like, desensitized itself. So the little shock waves that used to send different markets into a spin now just get shrugged off. So obviously there's going to be issues surrounding the Korean Peninsula, and that's probably the black swan. Nobody knows what's going to happen there. But that aside, the economy is ticking over quite well in all countries other than, I think, Europe. But the US, to show its strength, is actually increasing interest rates. So they're saying the economy is improving and it can now start increasing its interest rates.
So, Ken, the world's behaving itself. What's happening to the Australian economy?
The Australian economy is going through a bit of a rough patch, but improving. We're seeing low wage growth and higher prices, particularly in the areas of, call it, energy and health, which is constraining spending. So while business confidence is high and growing better, they're not translating that into hiring more staff and paying more, although the Australian economy is really now being supported by government spending, particularly in the areas of infrastructure. So most state governments around Australia are building roads. We're seeing rail. So there's a lot of employment. And what we're seeing is a number of those agreements were created with expected wage increases. So they're now starting to dribble out into those contracts, which will now dribble out into the general economy.
So consumer confidence is dependent upon people feeling comfortable about their wages, feeling comfortable about their jobs, and that's going to end up helping them feel comfortable about making big financial decisions, including property. But one of the things that's on people's radars is, if I take on a commitment, what's going to happen to interest rates? Quick crystal ball gazing, what do you think is going to happen there?
Interest rates have stayed relatively low, certainly over the last 60 years, and at current levels. 1.5. They're at the lowest level they've been. The pundits are really saying they're not expecting to see the Reserve Bank lift those rates, at least in this second half of 2017. The US is lifting their interest rates, but the problem in Australia is the high dollar. So if they increase those interest rates, I think it'll keep pressure to keep the dollar up, which is the opposite of what the Reserve Bank wants. So I think we should see interest rates stay low for a while. The problem, though, is people are spending out of savings at the moment. And certainly over the last 12 months, we've seen a reduction in savings going into savings, and we've seen an increase of people pulling money out of savings for the must-haves. So that's certainly putting a damper on the economy growing at a slightly faster rate. Unemployment is still low, but not low enough to increase wages. So that's going to be the telling difference over the next 12 months.
I agree with you, Ken, that interest rates are likely to remain low. The Reserve Bank isn't going to need to raise them to slow the property markets because APRA is doing its job on its own. We're in a lower wages growth environment, lower interest rate environment, so that's good. So that gives us a context to start with. So thank you, Ken, because I'm now going to whip around with the other experts to see what's happening in the Australian property market. So thanks for your time, Ken.
Thank you.
Now, let's work around Australia to each of the capital cities to get an understanding of what's happening in each of the local markets. My first guest today is Kate Forbes, National Director of Property Strategy at Metropole. Welcome, Kate.
Thank you, Michael. Thanks for having me.
Now, Melbourne's been the strongest performing property market for the last decade, and I know you're based in Melbourne, so we'll start that as part of our national whip around of the Australian property markets. You've got a team on the ground in Melbourne. How's the Melbourne market performing?
Well, it's quite fitting that you're starting with Melbourne in the whip around because it's actually been the best performer, certainly over the last decade and in fact over the last 20 years as well. In the last year, it grew 12.7% alone. And it's remained very fragmented, though, with houses growing much more than apartments have on average.
So what's been driving this growth, Kate?
Well, Michael, key to looking for areas that are going to deliver the sustained outperformance that Melbourne has delivered will always be the need to look at the fundamentals underpinning the economy. And there's certainly some strong fundamental drivers to Melbourne's in the form of very strong population growth and job creation. Melbourne's population is growing at around 2.2% per annum and has consistently been the fastest growing city in Australia. Last year alone, the population grew by over 146,000, and a large proportion of those were migrants who came here for the strong economy as we created more permanent jobs than anywhere else in the country. To be precise, a whopping 72,786 last year alone.
Great. So strong economy, strong population growth, people wanting to live here. As I keep jokingly saying, they're not coming here for the weather, but they're coming for the jobs, and that's giving them the ability, the affordability to buy things, not because properties are affordable, but because they've got the disposable income to do that. But they've pushed prices up considerably. So do you think it's too late to buy into the Melbourne property market?
It's definitely not too late, Michael, to get into the market, but the caveat here, as always, is that you're adding an investment-grade property into your portfolio. In a long-run investment strategy, your focus needs to be less on timing the market and more on what you're actually adding into your portfolio. But having said that, I see further growth in pockets of the Melbourne market going forward.
Yeah, I guess you're right. We're not buying the Melbourne property market. So the aim is, whether you're buying Melbourne, Sydney, Brisbane, buying that individual property in the market, which is going to outperform the averages based on the things that listeners to this podcast already know, our top-down approach and my five-stranded strategic approach. So based on those assumptions, Kate, what sort of properties are you and your team looking for that are going to make good long-term investments in Melbourne?
Michael, I guess the answer to the question is the same for Melbourne as it is for anywhere else. it's more important to focus on the location of the property first and then on the type of the property. So 80% of your growth is going to come from the location of the property, and then it's 20% on the property type. But when looking at Melbourne, the apartment market in particular hasn't performed as well as the house market, but it is likely to pick up in the second half of this year as the changes to the first home buyers grant filter through and a raft of new home buyers enter the market to buy up the established apartments. Also, your villa units in your well-located middle to inner ring affluent suburbs are tipped to do well going forward.
Sure. So nothing has really changed. You just got to be careful and make sure that your asset selection is correct. Thanks for your input, Kate. Look forward to catching up with another whip round at the end of this year when we'll actually see how these forecasts have panned out.
That would be great.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au.
My next guest is Ahmed Imam, Senior Property Strategist from Metropole in Sydney. Welcome, Ahmed.
Hi, Michael.
Now, Sydney's been one of the strong performing property markets. It's had a great run over the last 5 years. But as I said in the introduction to this session, it's run out of puff over the last little while. But you and your team are on the ground. So maybe you could give us some insights on how the Sydney property market's performing.
Yeah, sure, Michael. It's certainly been an interesting time. Look, overall, the Sydney market has grown 13% in the last year, but like Melbourne, it's been a fragmented growth. We've definitely seen stronger growth in the inner middle ring suburbs as opposed to the outer suburbs of Sydney. What's happening is that we're seeing capital gains in pockets in Sydney which were previously very strong, now being weighed down by affordability constraints and much tighter lending conditions. And as a result, the Sydney market is taking a well-deserved breather. You know, it's had a massive run up until now, and price growth is likely to moderate over the balance of this year. So you'll find the lower end of the market will benefit from the first homeowners incentives that came into effect on July 1st. And there seems to be fewer investment-grade properties on the market, meaning the buyer's agents team at Metropole in Sydney are starting to find really strong competition at auctions for the A-grade properties.
So what's been driving this strong growth up till now, Ahmed?
Yeah, look, I would say it's consecutive years of economic growth. You know, that is strong population growth and migration. We have a migration system that's got weighted population growth towards skilled working age migrants, and they're all bringing their wealth from offshore and buying properties in Sydney. In addition to that, we have strong government spend on infrastructure, which is in the billions. But what's interesting, Michael, is that property's also become a really popular and accessible asset class for baby boomers, you know, who are trying to create the wealth in the lead up to retirement. So all those drivers have led to the ongoing growth we've seen and that we continue to see.
Well, we've had that growth, and now it's taking a breather, and some people are worried it's reached the top. Do you think it's too late to buy into the Sydney market, Ahmed?
The $6 million question. I think it's a question
Everyone would like to know, wouldn't they?
Absolutely. It's a question I receive daily, and understandably so. Look, in short, Michael, no. It's not too late to buy, but, and this is a big but, let me be very clear that now more than ever, it is absolutely critical that you're buying an A-grade asset. That is the right asset in the right location. And let me give you a quick analogy, Michael, if that's okay. We're not too far off summer, so I'll make it a beach analogy. Let's divide the market into two categories. You know, you've got the A-grade assets and you've got the secondary assets. Now, let's say both those categories are surfers, you know, and every surfer is trying to catch a great wave. Now, in the last 4 to 5 years, both those servers were having a blast. There were waves everywhere, and not just any waves, but big waves with big breaks and big peaks. They were absolutely loving it. In fact, the waves are so big that even the A-grade surfer, who's much more skilled than a secondary asset surfer, you couldn't actually tell, because the waves were just perfect waves, and there were so many of them. But now we're starting to see a change, Michael. The waves are no longer perfect. The waves are not as big as they used to be, and they're also not as frequent. And as a result, it's now become a game of skill. Now the A-grade surfer has seen these types of waves before, and he has a skill to catch these difficult waves. And as a result, he's still looking good out there. However, the secondary asset surfer is now finding that he's struggling. He doesn't have enough skill to catch these breaks, and he's still starting to fall back more and more. And as a result, his weaknesses are becoming very obvious and apparent. And I say that because that's what is now starting to happen in the property market. Those who bought secondary assets during the peak period and rode the wave of good growth are now going to find this period a bit of a struggle. And those who bought and continue to buy A-grade properties are going to find themselves ahead of the pack.
Yes, I guess a similar analogy, as Warren Buffett said, a rising tide lifts all ships. When the tide goes out, though, you see who's swimming naked. So maybe that was his beach analogy.
Exactly
I like
right.
that story, though, Ahmed. I haven't heard that one before. So that was good. So having said that, and you've got to choose the right property, what sort of properties still make good investments in Sydney?
Sure. Believe it or not, Michael, we're seeing the strongest and most stable growth in existing and established apartments in Sydney. But not just any apartments, apartments in small to medium density boutique style complexes, probably no more than 2 to 3 story complexes with no more than, say, 20 apartments within the complex. At the upper end of the market, we're also seeing some strong growth in townhouses and detached houses as long as they tick all those boxes.
Great. So thank you very much for giving us your insights and your team's insights into Sydney. More careful property selection. But in fact, you always have to do that anyway, whether you're an A-grade surfer or a B-grade surfer. Thanks for your input, Ahmed.
My pleasure, Michael. Thank you.
My next guest is Brett Warren, the Senior Property Strategist from Metropole in Brisbane. Welcome, Brett.
Thanks, Michael. Good to be here.
Now, Brett, the Brisbane market really hasn't performed as strongly as the couple of markets we've already discussed, the Melbourne and Sydney market. What's really happening in Brisbane at the moment?
Yeah, look, obviously it's been a little bit disappointing. Overall, it grew about 3%, which is obviously well short of the other states. But that's been fairly fragmented, and there's still been some good growth in other stronger locations. And obviously the housing market's performing quite strongly, and in the good areas are performing very well and in high demand. But as you've probably seen, there's been an oversupply of apartments, which is leaving the market fairly sluggish. But overall, look, there's still some good investment prospects, and at the end of the day, there's some great places for young families to live reasonably cheaply.
So, Brett, what's been holding back Brisbane's growth when the climate is nice and the prices are half the price in some cases of Melbourne and Sydney?
Yeah, look, I think it gets back to a couple of things. Obviously, the last decade we've had the GFC that everyone had, but other states have recovered. Brisbane probably lacked that because it had the mining downturn where we lost a lot of jobs growth. People stopped coming to Brisbane for work, and our population growth really struggled over the last 5 years. But look, it's slowly starting to turn around, but it's definitely not the extent some of the southern states have been.
So what's in store? What's ahead for the Brisbane market?
Yeah, look, I'm using the term green shoots, Michael. We're just starting to see that population growth turn around again. And there's some good expansion of our major employment hubs happening. So that means jobs growth will start to pick up as well. We've got the Queen's Wharf project expanding through the city. Our airport's getting a second runway. And our hospitals are starting to expand as well. So Brisbane's going to look and feel substantially different over the next decade. And this will be a positive for property investors, but also homeowners.
Great. So when we talk about Brisbane, I think a lot of people think about Queensland, and Queensland really is a very big state. Brisbane's right down the bottom of it. What are we talking about? Are there certain areas that are performing better than others? Is this true of the whole market? What is your take on that?
Yeah, look, most definitely. The northern parts of our state have been significantly affected by that mining downturn. Jobs have disappeared and population growth in those pockets have as well. Brisbane has suffered to a lesser extent, but the areas that are performing well are the areas that always have those fundamental drivers, Michael, that we always talk about. Good infrastructure, excellent public transport, and access to those major employment hubs that are continuing to expand. And then we're just breaking it down into a bit more detail and looking for good school zones that are driving young families into the area. And walkability is becoming increasingly popular as well, and being able to walk to those lifestyle precincts and things like that. So they're the type of properties that are performing well and that we're looking for here at Metropole.
And I guess you've been avoiding the high-rise off the plan market, which is overall, when you do all the numbers and figures, dragging down the general averages, isn't it?
Look, most definitely. And that's been a big change with rezoning of land that used to be in factories or industrial area. Now you can put 200 or 300 units on there. So, look, that's obviously happened to a smaller extent in Sydney and Melbourne also, but they've had the population growth there to overtake that, and it hasn't quite happened yet in Brisbane. So we're steering well clear of those pockets anyway.
Well, many people are thinking I should maybe invest just a bit further out. What about the Sunshine Coast or the Gold Coast? Maybe the Gold Coast will do well because of the Commonwealth Games and all the new infrastructure there. What's your take on that, Brett?
Yeah, good question, Michael. A lot of people from the southern states think and feel that because there's actually quite an urban sprawl in Sydney and Melbourne, but Brisbane doesn't have that urban sprawl. The Sunshine Coast and the Gold Coast, they're predominantly driven by tourism, retirees and things like that. There's not enough dimensions to the economy. So you've got to be very careful of buying in those pockets, and longer term growth. We just go back to those fundamental drivers, and Brisbane's getting a massive employment hubs expansion, and that's where you need to be, where the economy's diversified, you're getting your population growth, and people and young families are settling in those locations more than ever.
I think that's a good point, that those holiday locations are very volatile. They're going to have their good runs, but then they have many down years as well. So not to get so excited. A great place to vacation, but not to get so excited when you go there and lick your ice cream and then think, oh, that's a lovely place I want to invest in. So are there still opportunities in Brisbane, and if so, where would you look?
Yeah, look, most definitely. You've got to be staying within that 10-kilometre ring. As I said before, we're getting another 1 million people to Brisbane in the next 12 to 15 years. So we want to make sure we're going to have good access to public transport. That's going to become vital. Employment hub access. So as you said before, if you're a half an hour drive from Brisbane now, once that population growth comes, you could be 45 minutes to an hour's drive. So it's important to get into those good pockets and access to those employment hubs will become paramount. And school zones is another thing as well with young families getting into those areas.
I think it's a good point, Brett, that really Brisbane, as it's growing, has to learn from other cities, not just Melbourne and Sydney, but international cities, that as they become more unlivable, as they become more crowded, that proximity, as you say, to transport, to infrastructure, to good schools, people don't want to be right on them, but they want to be in walking distance to them in many ways, don't you?
Yeah, most definitely. And look, that's a benefit we do receive from yourself and Melbourne and Sydney. We can learn some lessons from that. So it's a bit of an advantage for us Brisbane investors to be able to pinpoint those areas and stick to those known and proven areas.
Fantastic. Well, thanks for your time and your input, Brett.
Thanks, Michael.
Well, now that we've discussed the big three property markets in Australia, I'd like to go through what our research and our contacts on the ground are telling us about what's happening in the other big capital cities. So let's start with the Canberra property market, which really has been a quiet achiever, having performed quite nicely with home values increasing about 8% over the last year. And if you look over the long term, other than Melbourne and Sydney, Canberra is really the only property market to have achieved levels of capital growth above inflation in the last decade. I don't know if that point just got through to you. Other than Melbourne and Sydney, Canberra is the only property market to have achieved levels of capital growth above inflation, real growth, which I guess shows how the big capital cities and Canberra have decoupled from the rest of Australia. Now, over the 3 months to August, Canberra's property values only increased 0.4%, so they're slowing down as well. But as I said, 8% higher over the year, and house values have increased 9.8% over the year, but units in Canberra are not going up anywhere as much. Let's keep moving around the country, and let's go up to the top to Darwin, where the market is still suffering from the effects of the mining boom. And while some are suggesting it's near the bottom of the market, I believe house prices are still likely to keep falling in Darwin for much of this year. In fact, values across the Darwin are 18.6% lower than their peak, which was in August 2010. And as opposed to the East Coast, the big capital cities, where many jobs are being created, Darwin had a net increase of only 153 jobs last year. So there's no reason for people to go there. There's no growth drivers of the property market and none on the horizon. So it's clearly a market best avoided by investors. Okay, one of the big surprises over the last 12 months was the Hobart property market, which interestingly came out as the top performing market over the last 12 months. Property values in Hobart increased by 13.6% over the last 12 months. The local economy started to pick up, helped by redevelopment of the Royal Hobart Hospital and upgrades to universities, hotels and retail precincts. Now, even though some commentators are suggesting it's a good place to invest, I don't agree with that, because even though it's had some short-term growth, there are very few long-term growth drivers, and despite the current fast rate of growth, if you look back over the last decade, dwelling values have only increased 26.7% over the last 10 years, considerably below the rate of inflation. So this is just a little bit of a catch-up. It's not the beginning of long-term considerable outperformance, in my opinion. Moving to the other side of Australia, Perth market's still languishing. Now, some are calling it near the bottom, but I was only over there a couple of weeks ago doing homework and doing research, and our research shows it's still in the slump phase of the cycle with significant oversupply of properties for sale. And the statistics confirm that dwelling values fell 1.6% over the 3 months to August, and they're actually down 2.8% over the year. Houses dropped 2.7%, and because of the oversupply of units in Perth have dropped 3.5% over the year. So I'm not convinced it's a good place to be counter-cyclically investing. There are better opportunities elsewhere. I'm not a speculator, I'm an investor, so not time to get into the Perth market yet. What about Adelaide? Like the rest of Australia, the Adelaide market's very fragmented, with some suburbs showing 3 times the capital growth of others. Overall, home values increased at a respectable 5.8% over the last 12 months, while apartments and units only increased 1.1%. Again, there are very few long-term growth drivers in Adelaide, and over the last 12 months or so, only 8,000 jobs were created there. So really, there are better places to invest. We've whipped around the main capital cities, and the reason we've concentrated on those rather than regional areas is because the vast majority of our economy, the vast majority of our population live in the capital cities. And I know people live elsewhere, and I know there's great places to live in other areas, but I would avoid them as investment grade areas because it's not where the main economic activity is. What about rental growth? Well, that's accelerated recently, but yields have still softened over the last 12 months because even though rents are over Australia 2.8% higher, what's happening is that property values have in general gone up more than that. In regional areas, rents are 3% higher. So let's put it all together. Despite our low interest rate environment, Australia's property markets are very fragmented, and they're being driven by local factors, particularly things like job growth, population growth, consumer confidence, and of course, the old-fashioned supply and demand. And clearly we're moving into the next stage of the property cycle, one of moderate growth in some regions and virtually no growth in others. Now, the markets needed to calm down. There's been a 5-year run in Melbourne and Sydney, and it was unsustainable. Continued growth would have been dangerous, possibly leading to that bubble that those property pessimists have been worried about. So although house price growth's lost its momentum, we're not seeing any signs of material downturns yet. On the other hand, rental growth turnaround is going to be good for all of us as property investors. Now, I've invested for over 40 years, and every property cycle I've experienced has come to a halt because of finance or difficulty getting finance. Now, in general, in the past, booms have been stopped when the Reserve Bank increased interest rates to slow down the economy and slow down the property markets. And in the past, it's been very effective at doing this. But this cycle, it's different. APRA, the Australian Prudential Regulation Authority, has also attempted to put the brakes on investment lending, and in particular on putting limits on investors. And what they've done is create a credit squeeze. Now, look, I recognise at the peak of every cycle, there are people saying, no, it's not the top, it's going to keep going, it's going to keep going. And I guess the other thing I recognise is it's impossible to predict with any accuracy the moment the cycle is going to turn or it's going to top. I think it's a bit early to say it's topped and now it's going to actually turn and go down. But we are getting close to the peak of the cycle and definitely, as I said, to a period of more moderate growth. Now, another factor that's coming into it at the moment is affordability, and that tends to happen near the end of the cycle. Now, I'm not talking about first home buyer affordability, which they always seem to have trouble getting into the market, don't they? But established home buyers who are looking to trade up or trade down, but they're finding the high prices and stamp duty too much of a disincentive. So what they're doing at the moment instead is choosing to stay put, and they're renovating. They're staying in their own homes. Now, having said that, there's likely to be a little bit of life left in this cycle, but it's more likely to be a period of moderate growth in some areas and stabilisation in others. And then we're not going to have a significant fall in property values. APRA's slowed us down in a relatively low interest rate environment, and that's much better than what's happened in the past, where we've had high interest rates that have put people into mortgage defaults and stopped businesses borrowing. In my mind, it's not too late to buy an investment property at this stage of the cycle. Of course, it would have been better to buy 5 years ago or 10 years ago, but at this more mature stage, careful property selection is more critical than ever. And since our markets are fragmented and not all properties are going to grow in value and many will make poor medium-term choices, it's probably not a bad idea to get the on-the-ground team of Metropole on your side to help you. Now, you've heard a small group of our experts earlier on, but the beauty of having people on the ground is we actually know what's going on, because currently the signs are pointing to softer growth. But independent professional advice, careful consideration of what to do with your personal circumstances is going to be what's required. I find it really interesting that all successful investors, business people, entrepreneurs have paid advisors, and the average investor doesn't. Anyway, there we are. We've discussed what's going on in the Australian property market and what's ahead. We'll have another state-by-state roundup at the end of the year to see how some of these thoughts and some of these predictions have panned out. And I look forward to catching up with you again next week for my regular Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.